Welcome to episode 37 of the Special Situations Report, a podcast by Inside Arbitrage. I am Asif Surya,
And my name is Tamanna Surya.
and today we are thrilled to have Evan Tindell of Bireme Capital as our guest on this podcast.
Thank you so much for having me. I'm thrilled as well.
Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of this podcast for more detail.
So, Evan, I've been following your journey both by reading your investor letters and following you on Twitter for several years. It was a pleasure to finally meet you in person earlier this year in Omaha. Both of us got a chance to see you there. And then once again, spending a couple of days with you in New York this summer. So thank you so much for coming on.
Yeah.
We would love to have you take a few moments to introduce yourself and tell us about your journey.
Yeah. So after college, I was playing professional poker, which just means that I wasn't doing anything else for money. You got to be careful sometimes when people say they're professional poker players, because sometimes they're just like losing mom and dad's money. But yeah, I was playing professional poker, and a buddy of mine was thinking of going to work for his dad's hedge fund, and basically convinced his dad to hire me. Or he really told his dad that he didn't want to work one-on-one with him. like he had to choose between going to New York, where all his friends were, to work at like a big firm and have, an analyst class and blah blah blah, or be stuck with his dad one-on-one in Avon, Connecticut. So he said he had to have at least one friend there, and that was me. So I was kind of done with poker by then, and ready to kind of move on to the next thing, and had kind of gotten the investment bug already, because you can't take all your money to the poker table, right? So you gotta figure out what else to do with it. So we kind of already caught the investment bug, and yeah, just started researching stocks from day one, at it was called Ballantine Capital. And then when he offered to kind of seed us for our own firm in 2015, 2016, we jumped at the opportunity, and since then we've been growing what we called Bireme Capital, kind of since that point. And so it's still, despite how hard it's been to find value stocks that outperform, I've still kind of got the value bug, and I actually think now is maybe the best time in a while to actually tilt in that direction. But I don't know, I've thought that before, and it hasn't totally been true, so we'll see.
Yeah, it's taken forever for that turn to happen, and we're still waiting for it in some sense.
Yes,
Exactly.
maybe we'll be 90 years old and still talking about the the rebirth of value investing or something. But yeah.
On that point, what specifically led you to value investing as a philosophy, and what are maybe some of the signals you're talking about in terms of this new value tailwind, maybe in this era, hopefully not when
Yeah,
we're
I
all
mean,
90 years old?
I guess what first led me to value investing was just like asking some friends that knew more about investing, like, well, what books should I read? Like, what should I, how should I approach this money that's in my bank account that I made from poker that I can't take to the poker table? That friend who's now my business partner, Ryan, he pointed me towards value investing. But I guess that's maybe not as interesting as like why it made sense to me. And the reason why it made sense to me was, it just seemed like sort of finally there was like a rational framework to investing, rather than just like the mumbo jumbo of like technical analysis, or any number of other ways that people invest money, like just like knowing what the company does and liking it, and then just like throwing all your money in it or whatever. Like actually looking at the numbers and like how much in earnings am I getting per dollar that I'm putting in, actually spoke to me, because it's similar really to the proper strategy in poker. Like in poker, people, there's again all sorts of like terrible books and mumbo jumbo and superstition that are involved. But when you when you think a little bit more quantitatively about the game, it sort of reveals a set of kind of correct strategies having to do with, you know, how selective you should be in the beginning, and how you should play in later hands, and how you should analyze if you think your opponent's bluffing, and blah blah blah. And it's all kind of math related at its core. And so when I kind of found that there was a similar, kind of theory of investing that was first based on math, and then obviously there's more complexities on top of it, that just kind of really really spoke to me, and so I just kind of went deep on in that world, and I guess never left.
Yeah, so Evan, it's interesting you mentioned about technical analysis and the mumbo jumbo and all of that. I was talking to a friend who's a very astute investor, focuses on biotechs. And the discussion we were having was I was saying, I don't believe in technical analysis as well. But the more I think about it, in some sense, maybe the price action is capturing the psychology of the market, if you will, right? Because we know that it's not all math, it's not all valuation. The psychology part of it is maybe 60% of the move. So I've been paying more attention, if you will, to price action because it's telling me something. So I was wondering if you look at it the same way.
Yeah, yeah, no, I mean, and it is true that like um, the past price action is less random in the case of, like the past results in the case of a stock is definitely less random than, for example, like the past spins of a roulette wheel that people will look at. Like obviously the spins of a roulette wheel, unless there's something weird going on, unless you're getting scammed by the casino or you're scamming the casino, the past spins of a roulette wheel are completely separate from what's going to happen in the future. And I think that most people, like 99% of people that are doing technical analysis, are just trying to find patterns in like past spins of a roulette wheel. But there is still probably some analysis to be done there. I just don't know. I'm skeptical that you can do it well without like a PhD, without like without like a significant computer science background, and software that you apply to that question, because there are definitely people doing that. And if you're just doing it like looking at a chart, you're probably, I'd be skeptical. But who knows? Who knows? I mean, I'm sure
Yeah.
some people have made money doing it. People also probably lost a lot of money doing it too.
So very few Ed tops, if you will, in the world of
Yeah,
technical analysis.
yeah, exactly. But even he was obviously, well, it's funny you mentioned that, because he was actually trying to, his most famous thing was actually trying to find patterns in the roulette wheel, which I think is that what you're
Exactly.
referencing? Um,
Yep.
yeah, I was explaining that whole thing to a friend of mine yesterday. How him and Claude Shannon built the first wearable computer at MIT to actually try to predict, spins of the roulette. But even that didn't use. I don't think it didn't use at all past spins. It just looked at like where the ball was placed in the current spin and how fast it was going or something.
Yeah, the angle of the roulette wheel or
The angle,
things like
yeah,
that.
exactly.
Yeah,
Yeah, yeah, yeah. In a way, you might say it's more similar to fundamental analysis.
that's right.
Yeah.
Absolutely. I want to go back to that point you made earlier about many parallels between poker playing and investing. And from what I've gathered, one of the driving ideas behind Bireme Capital is exploiting existing investor biases in order to find and invest in mispriced equities, as you so put it. Much like how poker playing is about exploiting your opponent's biases. Could you talk through some of these investment biases, like social confirmation or the availability bias? And then, more importantly, why they work in terms of finding the best investment opportunities.
Yeah. I mean, I guess the number one thing about investing is like we're all trying to find some way to identify, stocks that are undervalued or overvalued, if you're in the case of shorting, but mostly undervalued. And you just try to set up a framework that you think will give you slightly better odds than just randomly picking stocks. Because if you can even do that, like if you can take the percentage of your portfolio that outperforms the S&P 500 from, you know, 50% to 60%, then you're probably like, you're gonna huge, that's like $1 trillion idea basically, right? um, and yeah, the idea with the behavioral biases, that I guess that kind of like my theory behind it, it might even be, you could even argue that it like has to be true potentially. But like, there are errors of analysis that are being made all the time, right? That's kind of definitional. Like if you take 100 people and put them in a room and you give them the balance sheet of a company and the income statement and all the 10 Qs going back 20 years, all the information about the company besides like the price action, besides like what price it traded at, and they will probably come up with vastly different valuations for the stock. I would bet, like, at least they're not gonna, at least 10, 20, 30. I mean, I would bet that the range is like 50% or something. But the variance is going to be, so, like, some of the variance is going to be positive, some of the variance is going to be negative, just because people have their own biases and just people see things differently. But when you net those all out, I think that the errors tend to be mostly canceling, and the result is that most stocks are priced pretty efficiently in the market, because you have all those buyers and sellers coming together, and some are too positive, some are too negative, but at the end of the day, like, the marginal buyer and seller are probably pretty close to accurate. But I've actually, in the past, I've kind of compared those errors, kind of canceling out to the the call to audience lifeline on Who Wants to Be a Millionaire. I don't know if you know that show,
Yep.
but you could, it's a quiz game, and there's usually four answers, I think, and one of the lifelines was call the audience, or like poll this, or ask the audience, and it was a very powerful lifeline. And if you don't think about it, you wouldn't necessarily know why, right? Like, it's like, oh, I guess the audience at Who Wants to Be a Millionaire is just like super smart, because like that's why they're there, right? They're like trivia buffs. But it's not actually the case. In reality, it's simply that there's four answers, and even if 80% of the audience is picking randomly, if 20% of the audience actually, or 10% of the audience knows the answer, then that will slightly bump up the prevalence of the correct answer in the responses. And that's how the lifeline becomes super powerful, because everyone that gets it wrong just picks randomly, and the people that pick right actually, sway the responses. But just like you could imagine a Who Wants to Be a Millionaire question that would engender, let's just say, less than random errors, like non-random errors. Like, for example, like anything politically related. Like, if you ask a question about global warming or gun control or what have you, you're very likely to get answers that are non-random. The Republicans will say that climate change, whatever the answer is, like the least amount of climate change is happening, and the Democrats will say the most amount of gun. You know what I mean? Like, it'll be super skewed. And in the same way, I think, while normally most stocks are efficient and you get this kind of, pressure on both sides of the price from various errors, in certain cases, based on, political bias, news flow, just things that happen to the company, where the company fits in the capital markets, whether it's like geography or like in a certain sector that it maybe doesn't really fit in, any number of reasons, the biases start to stack up on one side or the other, or the errors, I should say, start to stack up on one side or the other of the price. And that, I think, is what creates a mispriced security. So it has to be something kind of systemic or systematic, because if there's a mispriced security, it means that like everyone in the market that should be finding on mispriced stocks are not finding it, or they're not finding it with enough capital to actually move the stock. And the only way it can be something, just another word for a systematic error of intellectual analysis is a cognitive bias, basically. So I'm sure there's ones that we haven't really found yet or haven't been like, enumerated and analyzed in the literature, but that's kind of like my theory of why those things exist. And that was a really long answer to maybe only part of your question. So
No, no, that's fascinating, Evan. I mean, it's such a vast topic, if you will. I'm susceptible to these biases as well. One that I fall victim to often is the anchor bias, where I bought a stock or I saw the insider buy at $10 per share, for example, Lyft, and it's $18 now, and I just can't get myself to buy now, even though the world has changed and Lyft is a different company now than it was maybe 2 years ago. So I fall victim to these biases. I think even Kahneman and Tversky, when they talk about this, they say just being aware of the biases is not enough to get over them. So I'm wondering if I flip the situation a little bit. So you are exploiting these biases in the market for people like me who fall victim to anchor bias. How do you make sure you don't fall victim to these biases, and how do you keep out of that even after you're aware of them?
yeah, I guess I can talk about really one thing, I guess, that I try to do once I buy a stock. I guess there's either biases in terms of like your own analysis, like before you buy a stock, and with respect to that, I think it's really um, I find it helpful to have like a number of different um, methods for kind of getting stocks onto my radar, in terms of like not falling prey to the biases. Like for example, I think just like constantly like one bias that people certainly fall prey to is, and this is just in the case of stocks, it's called like home country bias, but it's just another example of familiarity bias. And really it's almost all of these are just, a lot of these are just other examples of like availability bias, or like what Kahneman called like what you see is all there is. So like, you're more familiar with stocks in your home country. So, I think it's important to just like constantly be looking at, if you have access to international markets, it's just good to constantly be looking at like new stock markets and make sure you're not missing anything. Like I was going through a bunch of like Malaysian stocks the other day, just to like, cause it's a new, Interactive Brokers has access to it now. And, I just want to make sure I'm not like missing anything there. So, in terms of like not being biased against things, I mean, there's another. I mean, the other like in terms of anchoring, that I think it's important to do is, um, and this is so hard, is like just refresh your like estimates about what a business could be worth, like what a company could earn, without any bias towards what you had in the past. Not any bias towards what the stock price is, any bias towards like whatever. Um, and that's really hard, like especially after you own something. So like,
Right.
yeah, so um, what I try to do is, if I already own something, obviously it's because I think it's going to earn. Usually, I mean, almost always it's because I think it either is already trading at like less than 10 times earnings, or like I see a path to where the earnings are going to be more than 10% of like what the current stock price is, like, because I'm just like I'm not buying things at 50 times earnings usually. um and if the stock doubles, if you haven't been careful to like update your estimates along the way, you might be tempted to just sell out of the thing, right? And there's every value investor complains about like selling things too early, right? So, yeah. So what
Yes.
I what I, what
Always.
I try to do is, I almost like, because I know that this bias exists. It's called the disposition effect. It's also just another form of anchoring. But it makes you hold on to losers and sell winners too soon. And I just try to make sure that I really give the company credit for any positive developments in the business since I bought the stock. Like, I try to go out of my, like, whereas I come in with conservatism, I I try to go, if I'm going to sell the stock, I want to make sure at first I'm at least giving the business like the full credit for everything that anything positive that has happened in the meantime. Of course, then still sometimes things outperform your expectations, right? Like we wrote a thing about pounding the table on Meta when it was $100 per share, and I don't remember where we sold it, but it wasn't in the 600s, and it's at 750 today. It was way lower than that. So you know, I at the time I gave the business what I thought was full credit for the improvements that were happening. I probably sold it like between 3 and 400 or something. I'd have to double check, but I did not expect them to be, on the cusp of earning like $34 per share. Earnings have tripled since year end 2020, which is wild. Um, so yeah, it's easier said than done, I fear on that end.
Absolutely, Evan. I still have about 25% of the position that I picked up under 100. And the only reason I picked it up was I was teaching a class to some folks, and Meta was one of the companies we used for DCF analysis as an example. And, we had come up with a $200 price target based on the DCF. And then he reached out to me after I dropped below 100, and he's like, "Hey, Asif, remember we valued this at 200? It's under 100 now." And I was so thankful he asked me that question. I was like, "You are absolutely right. This is a great value at this point. Zuckerberg is going to stop all this capital spending he's doing eventually, and you have half the world on his platform. So there's a lot of optionality."
And yeah, and I think it can also be hard to, it can be also, if you're kind of watching a company closely, but not like deep, just like kind of like watching it, but not like deep into the numbers. It can be hard to actually like if you when you just see it dropping in the market like all the time. It can be hard to, it can feel like you're just picking up nickels in front of a steamroller if you just like jump into it at that moment. Um,
Yep.
so I find it like in those moments I find it really helpful to have like a actual like forecast that I can look at and like try to tweak, to make sure I'm not like doing something idiotic in those moments, because it can feel scary.
Absolutely.
Yeah.
So forecasting and all of this, we spent a lot of time talking about, I guess, on the more long side of things. But another key part of Bireme, from what I understand, is that you follow a long short strategy as well, which is interesting because in recent years, shorting has become quite difficult. You have the retail investors pulling off short squeezes at GameStop, general memes. Exactly. The meme stock mania at BGT. And even now, I think we're seeing some pretty extreme irrationality at companies like Open Door. So, how does your fund in particular approach shorting in times like these of extreme irrationality? And then, how's your approach for shorting perhaps changed over the last 2 years?
Yeah, I mean, if you talked to my clients at the end of 2024, bunch of them, I mean, they were kind of mixed, but some of them basically wanted me to say that I was never going to short again. Because I mean, we were down in 20, the market was up, we were down in 2024, and it was rough. Um, it's always rough to lose people's money, even if it's a temporary thing, or even if you've made money for them in the past or whatever. And the second thing that people want to hear is like, oh, I'm never gonna short like companies like Open Door, or these other kind of like ridiculously valued things. And what we've tried to do is draw a line between things that like clearly have active short squeeze campaigns that are going on, um and just like simply ridiculously valued stocks. And we did make a lot of money in 2022 just being short things that were ridiculously valued. Um, but it's easy to say that. It's sort of harder sometimes to necessarily differentiate between things that may or may not have a short squeeze and things that are simply ridiculously valued. Because of course, if something has a ridiculous valuation, it's going to attract short sellers because probably the forward returns to the stock are negative on average. And then the more short sellers there are, the more possibility there is for some type of short squeeze. And I think if you looked at the academic research on stocks with high short interest and the returns to them prior to like the last couple of years, they are strongly negative, like they strongly underperform on average. And it's because, I mean, most people who are shorting things are somewhat know what they're doing, and they're not just doing it to light money on fire. They're doing it because there's some really ridiculously valued things in the market at certain times. So we've transitioned to like staying away from like trying to stay away from the most like biggest battlegrounds. But you know, uh, I think I had an interview with Value Investor Insight in July, and I said you can never really say you're not going to short the stupidest things as a short seller, because those are actually over time, those are the things with the strongest negative returns. I mean, like it's just, you know, like Open Door at the valuation it's at today is extreme. We're not short Open Door, so but I mean, the thing has never turned a profit and is now at a $6 billion valuation, despite the fact that its revenues are down by 75% since 2022. So, um, you never know, but I think people are going to lose a lot of money on these things, even if they're not easy to short. The long side is the one. It might not be easy to short, but the long side, unfortunately, is not going to do great in most of these.
And you would think people would learn the lesson after what happened to AMC and companies like this, or Carvana, although Carvana did come back up. But talking about Open Door, Zillow was in the same kind of business model, if you will. Redfin was. They all left because it's just not a business model that works. But with these situations, you never know. The Open Door might say they're a crypto treasury company tomorrow, and the stock would double yet again, right? So
I
it's
mean,
just
and
hard.
and yeah, the crypto treasury stuff is just perfectly sums up kind of the environment of the last few years, I think. I mean, you know, it's just back in 1999, companies would um, put .com on the end of their name and say they were starting a web, putting a website as part of their business, and the stock would go up by 50%. So I think a lot of the market these days is kind of focused on these essentially zero sum or negative sum kind of gambling opportunities. It's just a bunch of people throwing down money on the roulette wheel on random things and trying to guess. And then the fun thing about the stock market is it's not just roulette. You get to guess what other people are gonna. It's like if you're betting on what other people are gonna bet on roulette, and you know the Bitcoin treasury stuff is just CEOs you know being a random number on the roulette wheel and just being like, we're so lucky, you got. It's just they're just trying to get everyone to bet on their stock in the short term, and it's a mess.
Absolutely. We had Andrew Walker on the podcast a few weeks ago, and we were talking about Buffett's, casino versus cathedral analogy, and it certainly feels more casino right now than a cathedral, if you will.
Yeah.
Switching gears a little bit, Evan, there are firms that run extremely concentrated. You had Nick Zakaria, Nick Sleep, and Case Zakaria that were running with just 3 to 5 companies. And then there are funds that have hundreds of stocks. So Peter Lynch apparently had hundreds of thousands of stocks in his portfolio. So I've seen research that says that once you get to about diversification beyond 25 to 30 position, it doesn't help a whole lot. But I've also seen you talk about running a little bit more concentrated than that. If I'm not mistaken, maybe somewhere between 10 and 20 stocks. So it'd be great to understand how you think about portfolio sizing and diversification, and if any of that has evolved over time as you've run the fund.
Yeah, I think it's hard enough to have one good investment idea or 10 good investment ideas. I can't imagine trying to come up with hundreds or thousands of good investment ideas, like some of these firms have. I mean, I guess, it's probably most of these firms that have hundreds of positions have big teams built out. I have a business partner, but on the investing side, I'm mostly a one man shop. I have some various people that help me with certain things in the research process, but mostly I'm a one person shop. So I wouldn't feel comfortable that I could actually know the companies well enough to invest in them if I had more than 20 positions on or so on the long side. And I think that does fit in pretty well with the data on the kind of the, as you mentioned, the diminishing returns to diversification. Like I actually think it's probably like I would rather have a 15 to 20 stock portfolio where the big positions have like different types of risks, in terms of, you know, they're not all like uh Japanese automakers or something like that. Like, you know what I mean? Or
Mhm.
yeah, it's not like you have 15 stocks, but you have like three cable companies or something like that. That I think is probably more dangerous than having a smaller number of positions. So I try to combine like, somewhere between 10 and 20, but usually closer to like, yeah, 15 to 20 stocks. And then just always kind of be thinking when I'm adding a new like larger position, like does it have some kind of risk that's like related um, to the things I'm already doing. And I'm kind of I think it helps to be a generalist in that sense because obviously if you're a tech or media focused or like some other focused portfolio manager, you're going to have stocks with a lot of the same risks involved, and that obviously that can be a part of someone's portfolio. But like if I'm investing all like the vast majority of my own liquid net worth, like I want it to be at least somewhat diversified in the risks that the big positions have.
Exactly. So, speaking of how difficult it is to find good investments, as you just said, I was quite curious about your process to go ahead and find ideas. So, even when writing for Inside Arbitrage, we're combing through hundreds of companies each week to arrive at a single investment thesis. So, in the sea of information, how do you find interesting opportunities? Do you use stock screeners, sell side reports, primary research, or something else entirely?
I think it's actually important to do everything, to like do all of the above in terms of like what you in
Hmm.
terms of depending on how much time you have and like what you have access to.
Hmm.
So I try to keep I will let's see, let's go down the list of things. I'll read the Wall Street Journal and the Financial Times and just like come across random companies in there and then like read about them. I'll look at I'll use like Bloomberg's EQRV or similar, which just shows like the valuation of the company and it's like some of its peers. And I'll look through like look through like the comparables and look for ones that look cheap relative to stuff I already own. I might use a screen and go through like every company in a certain country, like every company in like Mexico or something that trades for below a certain valuation and has like enough liquidity that we could invest in it. In Japan, I mostly I start with screens, um, because there's just so many stocks in Japan that are there's like over 500 companies. And that this is excluding financials, materials, energy, and utilities. Excluding those four sectors, there's like 500 or 600 Japanese stocks that are more than 100 million US of market cap and trade below 10 times EV to EBIT.
Wow.
Yeah. So for those, I will screen and then I'll just start going through. I'll just try to figure out like do a quick. And I mean, the nice thing about AI for investment research these days is like the time to like understand like a little bit about what a company does, or even a lot of it about what a company does, is so much lower now because you can have ChatGPT read the documents in like whatever the language is and translate it. And so yeah, I try to use all of the above methods. And then I guess when I'm reading, when I'm going through those sources, I'm kind of constantly in the back of my mind thinking about like how it might fit, it might fit into like my kind of framework of like cognitive biases and when people make errors about certain stocks. Um, so in the case of like Mexico or Japan, it just might be that like the entire market is like being ignored by, it's like a home bias, familiarity bias thing across like the entire market. For something in Europe or the US, I'm more thinking about like, okay, what's like the story here, and how does that, what could be the error here, like what are people missing, um, and so I'll use that to kind of filter, just the wide funnel that exists from all these different sources.
And that makes a lot of sense. Evan, I was reading your recent interview in Value Investor
Mm.
Insight, and you mentioned that you follow special situations like mergers and spin-offs quite closely. So there are many ways investors approach these kind of events, and I'm aware of at least 6 different ways investors participate just in merger arbitrage. So what kind of signals do you look for in these corporate events, and why are they so important to your investment process?
Well, first of all, uh, I think compared to you guys, I probably pay attention very little to mergers and spinoffs because you guys are, the experts in those things. Um, so what? Let's just take mergers as a first example. I guess what I look for in merger arbitrage is I look for situations where the this I prefer situations where the spread is quite wide. Like I think most there are some merger arbitrage firms I think are more set up to um, you know look for the deals that are like pretty certain, and then they can put leverage on it, and it can be a pretty decent like uncorrelated return stream. And obviously there's firms that have done very well at that. I prefer situations where uh, there's already like an assumed significant chance that like the deal is going to break, and there's like a wide gap to the back to the deal price. And preferably, like the ideal scenario I think is where you kind of don't mind owning the resulting equity if the deal does break, because I think there can be weird dislocations where like the core investors of the company already sold to the arbs mostly, like
Yep.
the kind of marginal investor that's paying attention. Some of the people are not paying attention, but the marginal investor that's paying attention already sold to the arbs. And then when the deal hits a bump in the road because of some investigation or lawsuit or whatever, um, the arbs, some of them head for the hills, and there's no kind of like core group of investors to come in and say, well, the deal maybe is going to fall through, but like we're going to own the stock anyway. And so that type of situation I think can be very interesting. We invested in Humana back in like 2016. It's becoming so long ago now, 2016 or 2017, with the idea that like we thought the deal was going to break,
Mhm.
but like we just liked owning the bit. We were like looking at the forecasts in the merger documents, and it just looked really cheap to us, even though the deal was going to break. So I think it was trading at like, yeah, it was trading at like 150 or something like that, or like 170, which is a huge discount to the it was a huge discount to the deal price. But we just felt like there was no kind of constituency of kind of core investors. And then I mean, we could talk about the Elon Twitter thing all night probably. I mean, that was like the most, like, put it in the museum of situations that people were biased about.
Absolutely.
Exactly.
Like, you had certain, like, left-wing people who hated his Twitter account and just hated him and thought that, like, he's evil and he's going to get away with everything, and therefore, like, he's going to break out of the deal. He's going to get out of the deal. Then somehow you had other people who were like, well, um, he's he's God, and therefore he's right about the fact that there's too many bots on Twitter, and that's going to allow him to back out of the deal. So you weirdly had, like, both sides of the political spectrum, like, concocting. I think concocting, like, these, like, weird narratives uh, that were going to, like, allow him to get out of the deal. But if you actually, it was a perfect time where if you actually, like, dug into the real story, he was always going to have to he was always going to have to pony up the money. So that was another perfect situation. The one I failed on, I was just too scared to hold on, but we lost money in U.S. Steel. That was another one where,
Mhm.
yeah, it was another one where I think by any rational argument, the deal should have gone through. Like, U.S. Just, I'm not, maybe your listeners, since it's a, you guys do a lot of merger. The name is Inside Arbitrage, but they probably already know about the U.S. Steel situation. But in case they don't, yeah, there's this deal with Nippon Steel for $54, and the stock was in the 30s because both Trump and Biden said they were going to block it.
Yeah.
Biden said we'll see, but it should be American owned, and Trump said, yeah, I'll definitely block it. And anyone rational looking at the deal thought it should go through. Like, it was going to be better for the workers. You could, like, we talked to, I mean, this is so frustrating now because we did so much work. We went and talked to, like, the mayors of the towns in Pennsylvania that, like, around there. We talked to people from the union. We talked to people here in DC. We talked to people from Japan. We talked to so many people. We paid, like, lawyers thousands of dollars an hour to kind of tell us what they think. We talked to people, like, old people who used to be on CFIUS, like, under someone that was on CFIUS under Trump. We talked to, and he basically said, yeah, if they recommend against this deal, it, like, rips up, decades of tradition and, like, decades of kind of, like, rule of law in terms of, like, the way CFIUS is supposed to work. CFIUS is the Council on Foreign Investment in the United States, which theoretically makes recommendations to the president about, like, the risks of a foreign transaction. And so we just thought I thought there was no way that at the end of the day Biden wouldn't do the right thing for the U.S. And I definitely underestimated I don't know, the cynicism or the whatever, or some promise he made on the campaign trail. But then I also, and then once Biden came out against the deal, I knew that obviously Trump would have a chance to revisit, like, it was gonna go on, but I didn't know what to think about Trump. So I punted that one, unfortunately, because obviously Trump, he made the deal. He's a deal man, I guess, at the end of the day.
Yeah, and that whole situation, I know a bunch of funds were long merger arbitrage focused funds. And to your point about wide spreads, some of the best ones with the best track records actually invest in the wide spreads,
Hmm.
but they also hedge the position a little bit with options.
Interesting.
So when we saw the second CFIUS review, that was a big signal to us. And we called that out, I think, on the podcast because we had never, at least in my 15 years of following merger, I'd never seen a second CFIUS review. And so this was such an unusual situation. He was asking for that second CFIUS review because he wanted to basically then greenlight the deal earlier this year. And I think, like, Dan Loeb of Third Point picked up on that. A few funds picked up on it and started a position after that happened. So yeah, all around fascinating situation.
Very unprecedented.
That's interesting because, one bias that I think I've definitely fall prey to this. I don't ever, I don't think about it, actually. So this is good. there's a bias against looking at things that you've already like sold or like made a decision on.
Yep.
But
Yep.
actually, you know a lot about that stock, right? Like I kind of I stopped following it super closely. So I don't
Hmm.
even know like when did Trump called for another CFIUS review?
The second one, was it in January or Feb that we talked about this? It was
Yes.
very early on this year.
Yeah,
And
yeah.
then
So by then
after that,
I blew out of the position in January after Biden, made his decision. Um,
absolutely, yeah.
yeah.
And last year was hard. Yeah,
But if I've been paying closer attention, I might have seen that, or maybe if I'd been an inside arbitrage subscriber, maybe that was my bad
Great.
there.
just listen to this podcast for
But
free.
it's
Even
hard.
then,
But it's hard. It is hard it's hard sometimes to mentally revisit something you've already kind of made a decision about because like you know unfortunately our brains, and this is again another bias, but our brains are wired to kind of, they're not thinking in terms of dollars, they're thinking in terms of wins and losses. This is the whole reason for the disposition effect and why you hold on to losers for too long and sell winners too quickly. But yeah, it's like, okay, so if I sold US Steel and I lost only a little bit of money, and then but if I go back in and I analyze it again, and I get it wrong again, then it's like two losses, blah blah blah.
yeah,
But it's that's not really how it's not proper rational thinking about how to make money for investors, right? That's just like keeping a scorecard. That's you can't, your clients are not going to be able to retire with your scorecard. They retire that with the money that you make them over time, right? So
absolutely.
Exactly. That Nippon Steel US Steel deal was unprecedented in many forms. And just speaking about international opportunities in general, both in that Value Investor Insight interview and throughout this podcast, you've mentioned that you're really looking at international markets these days. I know you've been looking at Mexican infrastructure, African telecom, and then Japanese semiconductor equipment. So, really, really broad scope there. Given that you're running a US-based fund, what specific structural advantages do you see in international markets as compared to domestic opportunities? And then a little bit more proactively, do you think US investors are handicapping themselves by having a home bias? Or are there legitimate reasons why someone should pay up for like the relative predictability and transparency of US markets versus higher returns abroad?
there's a lot in there.
Yeah, it's a
Um,
pretty lengthy question.
yeah,
Feel free to tackle it any way you
I
want.
think the number one rule in markets is there's a price for everything. And anyone who doesn't believe that is just wrong or stupid or both, unfortunately. Um, and I think there is an advantage to the U.S. legal system, the dynamism of the U.S. economy, and various other things about running a business in the United States. Um, However, it's not all roses, right? Like just think about competition. Like if it's harder to run a business in another country, it's probably also harder to start a startup to compete with said business in another country. Um, so I think a lot of ideas can be kind of flipped on their head in that way to show why it actually could be better to invest in another country. However, transparency and rule of law, I think, are generally kind of like a one-way street in terms of how they affect valuation. So, all else equal, I probably would rather invest in the United States than elsewhere if things are trading at the same valuation. The problem is, all else is definitely not equal in this case. Like, I'm going to a conference on Sunday, and I'm I'm presenting RS Technology, which was in that value investor uh, issue that I was in. And in the beginning, I have this slide showing um, the percentage of stocks in various markets that trade for less than 10 times EV to EBIT, like which is the metric I mentioned with respect to Japan earlier. And in the US it's like 5 or 6% of stocks. In Brazil and Mexico, it's like 50% plus. So you're literally like in the US, you're on a golf, you're in terms of like trying to hit something, you're on a golf course with like a big fairway and there's, a tree in the back of the fairway and you're trying to hit like a 9 iron that like hits the tree, right? Like it's a 1 out of 20, 1 out of 100 shot. In Mexico and Brazil, you're just in a forest, and if you just whack the ball in a given direction, you're going to hit something, you're going to hit a cheap stock basically, right? So I definitely think now more than ever, investors are doing themselves a disservice if they don't look at international stocks. Um, obviously investing only in the U.S. it has worked very well for a long time, but in economics and in markets, there's an exact there's an exact relationship between what's worked well for a long time and what isn't likely to work in the future, right? That's why there are cycles. And the reason being is valuation, because it's one of the reasons why it's worked so well to invest in the US is because valuations in the US markets have been rising. But it's like it's a rubber band that probably snaps back at some point, right? I mean, um you can't have Walmart US trade for 35 times earnings and Walmart Mexico trade for 13 times earnings forever. Like
Wow.
you
Yeah.
can't have, and I actually don't, that was like a few months ago. I don't know exactly where Walmart, now I want to look it up. Where is Walmart exactly trading right now? But yeah, that was, or, that was roughly what it was. Yeah. Walmart US is trading at 40 times forward, and Walmex is trading at 18 times. So it's half the
That's
valuation. I mean, if you would have told someone 15 years ago, um, what should trade at a higher multiple, Walmex or Walmart? They would say, okay, well, you know, Mexico has more population growth. It's got a lower GDP base, which means it has a longer like growth, longer scaling factor. It's like an up and coming country. It's close to the U.S. It's got like all these, there's like nearshoring, blah blah blah. Whereas the Walmart U.S. business is like is a more mature business. So you could actually construct a lot of good arguments why Walmex should trade at a higher multiple than than Walmart US, right? And yet here we are. So yeah, I think definitely investors are doing themselves a disservice if they don't look outside the US. And I forgot the rest of the question.
Yeah, you
no,
covered
no
it all.
worries.
That's perfect.
You did. I mean, you make a good point, Evan. I mean, you were talking about Chat GPT using AI tools earlier on. For us to ramp up on new companies, because we constantly come across new ones, is we've developed almost one full page prompt that tells us, all the things we need to know about the company, at least in the starting stages of our research. And that, to your point, could be applied to international markets as well, to try to understand some of those nuances, to be able to translate source documents. Because one of my issues is, do I go to the Canadian Cedar to get the stuff, or India's SEBI, or the equivalent in Japan? And how do I translate those documents, and what gets lost in translation? So some of those things were holding us back. But with these AI tools, I think you can get quite a ways there.
Yeah, and I think with Japan, once I started really digging into it and I looked at some of the valuations, I just decided that, you know, like it's one thing if you're investing in like unfortunately China and Japan are very different, I think, in terms of the reliability of the financial statements and the rule of law in the country and things like that. Like it's one thing if you're going to invest in a country where the government's going to wake up one morning and like take over the company, like maybe some African thing. Although I think that doesn't really happen in Africa either. Or like in China, where you have to worry more, just because of the history of defrauding investors in some of the publicly traded companies there, and like the fact that cash can get trapped and whatnot. Like where you have to have more like structural worries about the actual like what you own as an owner of the business. Um, Whereas just worrying about what gets lost in translation, I think makes a ton of sense. Again, if you're looking at things that are, one thing is 20 times earnings and the other thing is 15 times earnings. You're like, okay, maybe I don't quite understand the thing that's 15 as well because it's in Japan or somewhere else. But I think the more I looked at the Japanese market, the more I just was like, you know what? I'm going to translate these documents and I'm going to have an interpreter, and I'm probably never going to understand things as well as someone that lives in that has lived in Japan their whole life. However, the valuation discounts are so freaking huge that it just doesn't matter. Like, I'm still gonna crush, I think, the U.S. markets over time by buying those stocks, even if you can't always exactly translate every document perfectly.
So we spent a lot of time talking about general investment themes, and I want to focus in on a specific company that I've heard you talk about a few times, and a stock that we've discussed quite a few times on this podcast as well, and that being Lyft. We've seen the company's CEO purchase shares twice this year, and I believe he last purchased shares at the start of this month. And they had a C-suite transition recently with a new chief accounting officer appointed in July of this year. So showing up on our radar multiple ways in terms of special situations. For some context for viewers, Lyft has been doing quite well financially over the last year or so. They finally achieved profitability and seem to be generating very consistent and stable cash flow over the last few quarters. However, the company does seem to be overshadowed by its largest competitor, Uber, or flashy new entries into the robotaxi market like Waymo. Funnily enough, I actually took my first Waymo ride literally yesterday in SF. And quite frankly, I was shocked to see that practically every fourth car was some sort of autonomous vehicle, primarily Waymos, and the occasional Zoox as well, which is Amazon's self-driving vehicle headquarters right nearby.
Wow.
So Lyft seems to be a company you're also interested in. Could you walk us through how you're thinking about the business and then what attracted you to a name that many investors have written off in some sense?
I mean, really, really, that was like what first kind of got me interested in it. I was like, um, it's a clear kind of like also ran in the the ride. I guess, are they still calling it ride sharing?
Yeah.
In the mobility app world, it's a clear kind of second fiddle. And honestly, I had it on my list to look at it as a short. I had it on my list to look at it as a short because I just figured, I knew that Waymo was taking market share in SF. I'd seen that data. I, in my personal life, I hadn't looked for a Lyft in a while. I just generally use Uber. And so I just figured that they'd be like seeing declining revenue and their profitability would be going away. Well, I assumed they had never been profitable because I hadn't looked at the actual financials in a while. And then I was pleasantly I was oh I don't actually, I wasn't pleasantly, I don't really care. Maybe I would have been more pleasantly surprised to see the business doing terribly so I could just short it. But I actually saw a business that, the market cap is down 50% since 2021, and yet it's gone from 3 billion in revenue to 6 billion in revenue, and from unprofitable to 500 million of EBITDA and like 800 million of free cash flow on a trailing 12-month basis. Or even, no, on a billion of free cash flow or something on a trailing 12-month basis on like a $7 billion market cap. So then I was like, wait, what is going on here? Because I thought, and it's going to grow revenue 13% this year. I was I was like honestly pretty shocked about that. That it was still growing so strongly, given the fact that Waymo is kind of cutting into some of its bigger markets. Um, and I guess what I found was, I mean, I haven't bought the stock yet for sure. I don't feel like I've figured it out. But you know, given I'm always attracted to stories where the numbers just don't match what the story is out there in the news. And I think I brought my original bias to like looking at the company to say, hey, I had this on my list to look at as a short for a while. Let's like go revisit this. Um, and then I was like, wait, the numbers are telling me a different story. So, of course, the numbers only tell what happened in the past, right? So like, you could always, there's always the worry that you're gonna, be, you know, driving in front of the steamroller, or whatever the analogy is, picking up pennies in front of the steamroller. But yeah, so I just got super interested in kind of their attempts to, continue to grow in the face of this autonomous competition, see what their kind of strategy was. And then I learned that I knew that obviously that a couple Chinese companies are pretty or decently far along in autonomous, but I didn't actually realize that Baidu was so far along with some of their testing. They have, I think, over 1,000 autonomous vehicles on the road in China. With they did like I think it was 2 million miles or kilometers or something of rides last month. I think it's either last month or last quarter, but it's on the same, roughly the same level as what Waymo is doing, and they're so it's just interesting to see. I mean, I think I don't know what you guys think, but it seems like the jury is still very much out in terms of the percentage of autonomous versus regular riders you'll need. I'm sure it will vary by market, and then how does that kind of play out? I mean, if Waymo is currently like a couple percent of ride sharing in the US, I think, and even like aggressive projections only have it getting to like 10% in the next kind of few years, like next like 4 or 5 years.
Hmm.
But the market's growing 10%. So I don't
Exactly.
I find it, unless Google is really going to ramp up the number of these, or even unless they're going to ramp up the projected rate of like building the cars, it seems like there's maybe like still like a 10-year runway for this thing to keep growing. And if that's the case, it's probably pretty undervalued. But I haven't gotten comfortable yet that I fully understand what's going on there.
And same here, even though it keeps showing up on our radar multiple times. Like you, I always use Uber because I could use the same app internationally in many countries and worked out well. And then when we were in Omaha earlier this year, just because of the tremendous demand there was for these cars, we ended up downloading Lyft and it worked out really well. And we started paying closer attention to it. Our concern is the same thing, right? So is this company going to be disrupted, kind of like the New York taxis and the medallions were disrupted when Uber and Lyft came along? Or is there a partnership opportunity? And even if there is an acquisition opportunity, I mean, $7 billion dollars for some of these multi-trillion dollar companies is nothing if they want the network. And clearly, Lyft has the network effect along with Uber. So we are trying to kind of make that decision and understand that aspect of it better. So, Evan's
Yeah,
same situation.
it's
Yeah.
it's going to be really interesting to see how the partnerships evolve. Like, you know, Uber is also working with Baidu. Um, Uber is working with Waymo already in a couple cities, I believe. You can order a Waymo on Uber. I, I'm definitely a believer that like at least there will still be a lot of human drivers on the for these apps on the roads for a while, but obviously it depends a lot on the timeline in terms of if this thing still has a 20-year growth path, then you're going to make a ton of money before all the robots take over. But it's
Indeed.
hard to know. One question I have for you is I thought I saw somewhere someone was like calling into question the insider purchases and whether they were related to like required stock ownership levels or something. Was that Lyft or was that another company?
It
That
was
would have
another
been for
company.
Under Armour, I believe.
Oh, that was
We
for
were
Under
talking
Armour.
about
Right,
that
right, right.
earlier,
Okay.
yeah.
So you guys
So
think
Under
that
Armour
the
insider purchase is really interesting. Lyft, I think we'll have to dig a little bit deeper into the filings, but on a surface level, it doesn't look like it's part of any ownership, right?
okay.
Yeah, we had a hunch on Under Armour, and I told Tamana to go look into the SEC filings to see if she could find whether it was a required thing situation, and she did find them. And four directors of Under Armour had bought, and she found that all it was because of that requirement. Sometimes stuff like this is revealed in the footnotes of the Form 4 filings, but sometimes it's not. I just pulled up the footnotes of the Lyft Form 4 filings, and I didn't see anything related to that yet.
I had it in my notes to look at, and look at Under Armour with a bias towards shorting it as of like earlier this year. And now I'm annoyed that I didn't do it yet because it got crushed on earnings.
It did.
Exactly. I think we'll ask one last follow-up on the Lyft theme here, and then we can move to our rapid fire questions. But you mentioned the Baidu simultaneous partnership with both Lyft and Uber. How are you viewing this double partnership in a sense? Does this feel like a bidding war situation where one platform might try and secure exclusivity? Will a bidding war come to the detriment of Lyft then? Or will the possible exclusivity be a good sign for the business? How are you viewing this competition between the two? Or the
Yeah,
competitive landscape as
that's
a
a great
whole.
question. I mean, it seems like in the case of Uber, and Lyft as well, they're going out and they're partnering with kind of any autonomous providers they can get their hands on, depending on what market it's in. And it also seems like they're in like very mm, highly variable stages of like actual deployment. Like I think in Atlanta, supposedly Lyft was going to be having these like May mobility cars that were going to be available, but I haven't. But then I did a bunch of checking. I couldn't find like there was like one guy who posted a ride on Twitter or something, and he posted a video from it. But like for the most part, I think these are still very much in testing phase. I believe the Baidu vehicles, correct me if I'm wrong here, I believe the Baidu vehicles are Lyft is actually buying them, rather than it just being part of like Baidu's like on Baidu's balance sheet that then can like access the Lyft network. I'm not actually sure what I'm not. I believe that's the case. Or at the very least, they're going to be the ones that are like maintaining and like kind of like operating the car as it's on their network. Um, so I think if regardless of whether it's a purchase or they're just maintaining and operating the car while it's on their network, it seems like maybe it can coexist with Uber's partnership. It'll just be kind of, and actually it might, to the extent that like the cars are like individually, if one's being maintained by Lyft, I assume that vehicle will only go on Lyft's platform, even if it's also Baidu versus like a Baidu Uber vehicle in the same town. In a sense, that might even be slightly better in terms competitive wise than the most like Uber and Lyft drivers, because like the average Uber and Lyft driver, a lot of times they're driving for both platforms, and then it's like it can be like a big competition to see who could offer them the most like guaranteed miles or the highest payout or what have you. So it seems like it could be fine competitively for them to both partner with Baidu, but you know, it is um obviously it won't be some like major source of differentiation. Like
Yeah.
they're not gonna beat Uber with Baidu vehicles if Uber also has the Baidu vehicles. So
Yeah, you're right. I think the Lyft ones are directly owned. And I think they're right for now, at least there's a geographic separation. Lyft is going with Baidu in Europe and Europe only, whereas Uber has markets outside of the US and mainland China. So Asia and the Middle East is where they're first launching. So there's geographical separation. And as you said, Uber is deploying these vehicles through the app, whereas Lyft is owning them. So interesting to see how that relationship might continue to develop and
yeah, I mean,
progress. And
I'm yeah, I'm just excited to ride in all these vehicles. Wait, it, so is but it, are the are, is well, you said Uber is partnering with Baidu in the U.S. or outside
outside the US, outside
outside
the
the U.S. Yeah,
US.
because I don't think the Baidu
Yes,
cars are like approved to drive anywhere in the U.S.
I
Probably.
don't think so, no.
That's going to be another super interesting, um, probably point of political contention is like at what point do we allow Baidu and BYD, frankly, vehicles to like operate on the streets of the US. It seems like it must happen at some point, but yeah, who
Mhm.
knows?
Yeah. Right now, the tariffs on those vehicles is so massive, it doesn't quite work. But, Evan, I'm glad you talked about how the Baidu partnership is different with both Uber and Lyft. That's something I hadn't picked up on. And sometimes this is one piece of information that changes your mind on an investment thesis. And for me, that was it during this conversation. I'm going to take a very close look at Uber now and Lyft. Actually, Lyft is what I meant. Evan, we're going to wrap this up with a few rapid fire questions. Just, we like to ask the same questions to all our guests. And so the first one is, who were some of your mentors that made a difference in your investing journey?
my biggest mentor throughout my career has been, my ex boss Steve Ballantyne. You know, he was the one that gave me my first job in the industry and kind of like nurtured me along the way, and most importantly, kind of gave me responsibility like kind of early on in terms of, within the first year or two that I was there, I could like bring him an idea and get it into the portfolio pretty quickly if he kind of agreed with with my thesis. So I think that was huge from the beginning to actually like have kind of skin in the game and have some responsibility as far as getting your ideas into the portfolio. And then I mean, secondarily, I think my my biggest mentor has just been like the wealth of information on the internet. That sounds so dorky to say, but like I learned how to play poker like almost exclusively from online forums, actually. Like books, but then actually the books of a particular publishing company, they have an online forum that's like operated by that publishing company. And these days it's people I met off of Twitter or Reddit or whatever the case may be. I feel like there's, or Some Zero, Value Investors Club, like Seeking Alpha. I feel like if you go to all those places, there's never been more information about investing out there to learn, which I think is a positive thing.
Yeah, that's
Absolutely.
wonderful. Speaking of that wealth of information, are there any specific books that you've read or podcasts that you've listened to that you particularly enjoy or found actionable advice from?
Mm. Let's see. I'm like looking at my some books back there. Um, my favorite book about like economics and business and finance is definitely, I mean, this is a lot of people have said this is their favorite book of the years, but is The Prize. It's specific to the oil industry. It goes through like the entire history of the oil industry and how it relates to global geopolitics and World War II and stuff like that. And I think it's um, I love books like that that give like an entire history of a single industry. And I feel like you can learn. I feel like you can learn so much from that. So it's not doesn't have no particular uh, investment book, I'd say, come off the top of my head. It's all the old classics, but that one's probably my favorite book that tell people to read.
Yeah, yeah, you're right. I mean, some of these books, like, Sam Walton had a book that he wrote, I think, Made in America. That was a great history of Walmart. You have Shoe Dog by Phil Knight. That was an interesting read. Really enjoyed some of those. So
Yeah.
I'll go check out The Price. I've done a lot of oil and gas investing,
The
quite
other one
unsuccessfully.
is another one is, I think it's called The Banana That Ate the Whale or something like that.
Oh,
It's about the origins of like the modern um banana slash fruit industry and how it relates to like some various coups d'etats in Central America, and it's a that one's a super fun read. Yeah.
Cool. Yeah,
I think that
we'll
sounds
check
great
that out.
as well.
Yeah.
Okay.
Evan, thank you so much for coming on this podcast. This is a fascinating conversation. Usually, I look for one or two insights from books or podcasts that I listen to. Got way more than that from this conversation, and it's been a lot of fun talking to you.
It was a pleasure for me as well. Yeah.
Thank you so much for coming on. And that wraps up episode 37 of the Special Situations Report. It was absolutely wonderful having Evan Tindell on as our guest for the podcast this week, and we'll go back to regular programming next week, covering all event driven activity. However, if you'd like to access a more comprehensive weekly overview of all special situations activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the event-driven world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided on this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.